You quickly open your banking app on your phone. You're just checking to see if your rent check finally cleared, or maybe you're trying to see if you have enough buffer in your checking account to justify buying lunch today instead of eating the sad leftovers you brought from home. That's literally me half the time. But before you can even see your account balance, the screen grays out. A little pop-up box blocks everything. It says, "Please update your annual income so we can better serve you." You pause. Actually, you did just get a raise a few months ago. You got a nice little bump in pay. So, feeling a little bit proud because, hey, you earned it, you delete the old $55,000 number and proudly type in $75,000. You hit submit, the pop-up vanishes, you go about your day. 2 weeks later, you get an email. Congratulations, your credit card limit has been automatically increased from $3,000 to $12,000. You feel great. You think, wow, my bank trusts me. I must be doing really well financially. Look, I need you to stop doing this because what just happened wasn't a reward for your hard work. It was the bank baiting a trap. My name is Scarlett, and I spend way too much time thinking about the hidden psychological traps in our financial system. If you're someone who feels like you're making decent money, but somehow still living paycheck to paycheck, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the thing. We have been heavily conditioned to believe that when a bank asks for our income, they're doing it as a courtesy. They use friendly, helpful language like better serve you or tailor your financial products. But let's challenge that right now. Your bank is not your friend, and they are definitely not your financial advisor. Your bank is a publicly traded corporation, and their primary, most profitable product is debt. When they ask for your updated income, they aren't checking in to see if you have enough money to retire early. They don't care about your emergency fund. They are checking to see how much monthly debt service you can legally and mathematically endure. Giving your bank your updated income every time they ask is like walking into a casino, handing the pit boss your recent pay stubs, and asking, "Hey, based on this, how much do you think I can afford to lose today?" You would never do that, but we do it with our banks, constantly. Now you might be thinking, but Scarlett, wait, having a higher credit limit is actually good for my credit score. It lowers my credit utilization ratio. And mathematically, you are absolutely correct. Credit utilization makes up about 30% of your FICO score. If you have a $1,000 balance on a card with a $2,000 limit, your utilization is at 50%, which hurts your score. If you update your income, the bank bumps your limit to $10,000, and suddenly that same $1,000 balance represents just a 10% utilization rate. Your credit score shoots up a few points. It feels like a massive win. But here is what most people don't realize. Banks know exactly how human psychology works. They literally have behavioral economists on payroll whose entire job is to figure out how to get you to spend more money and carry a balance. They know that if they give you a $10,000 limit, your brain subtly reframes your financial reality. Let's look at the real dollars and cents here. Say you're bringing home $4,000 a month after taxes. Your basic living expenses are $3,000. You have about $1,000 of monthly breathing room. If your credit card limit is only $2,000, your brain sees a very hard, very fast wall approaching if you overspend. The friction of hitting that limit keeps your behavior in check. But if your limit suddenly jumps to $12,000 because you told them about your new salary, that psychological friction completely disappears. When your car needs new brakes for $800, instead of pulling from your cash savings or cutting back on going out with friends that month, you just put it on the card. I have plenty of room, you tell yourself. The next month, you see a cheap flight to Mexico for $500. You put it on the card. Then it's a random Tuesday night Amazon binge because you had a stressful day at work. Before you know it, you've succumbed to lifestyle creep and your balance is sitting at $4,500. Let's do the math on that. At a 24% APR, which is pretty standard for credit cards right now, that $4,500 balance is generating $90 a month just in pure interest. That's almost $1,100 a year of your brand new hard-earned salary going straight to the bank's bottom line. You thought you were getting a higher limit to trick the credit bureaus into getting you a better score, but the bank knew that a huge percentage of people, when given a longer leash, will eventually hang themselves with it.
You became a drastically more profitable customer the exact second you typed 75,000 into that pop-up box. In fact, if you dig into the data from the Federal Reserve, you'll find a statistic that always blows my mind. Households making over $100,000 a year actually carry more credit card debt than households making $50,000. Why? Because their incomes afford them higher limits, and human nature fills the space it's given. Here's where it gets really interesting. It's not just about credit card limits. When you willingly hand over your current income data, you are feeding a massive algorithmic profile that dictates exactly what kind of marketing you see across the financial sector. Have you ever noticed that the exact moment you get a raise and update your bank profile, you suddenly start getting bombarded with pre-approved offers for things you didn't even know you wanted? Look, the modern banking business model relies heavily on cross-selling. If you only have a free checking account with them, you actually cost them money to maintain. If you have a checking account and a credit card, you're better, but still just average. But if you have a checking account, a credit card, and an auto loan, now you are their favorite kind of person. When you tell them your income has gone up, their system immediately calculates your debt-to-income ratio, or DTI. If they see you make $6,000 a month, but your current minimum debt payments are only $500, their algorithm goes into absolute hyperdrive. This person has $5,500 of uncaptured monthly cash flow, the system says. Let's fix that. Suddenly, you log in and see a banner. You're pre-approved for a $40,000 auto loan at a competitive rate. You check your mailbox and there's a glossy flyer offering you a $20,000 personal loan just for being a loyal customer. I had a client I was helping a few years ago. Let's call him Dave. Dave was incredibly disciplined. He drove a 10-year-old Honda Civic that was completely paid off. He was debt-free besides his mortgage. He got a massive promotion at work, jumping from a mid-level role to a senior director, effectively doubling his income. One day, he's logging into his bank to transfer some money, gets the income prompt, and proudly types in his new 6-figure salary. For the next 3 months, his bank relentlessly targeted him. Every time he logged into the app, every time he checked his email, he saw a message, "Dave, upgrade your ride. You're pre-approved for $60,000. They framed it entirely around his success. The subtext was basically, "You've earned this. Don't you want to drive a car that reflects your new status?" Eventually, the marketing wore him down. He started looking at cars just for fun. 2 weeks later, Dave bought a $55,000 truck. Now he had an $850 monthly payment plus higher insurance, completely eating up the extra cash flow his promotion had just given him. The bank didn't care about Dave's net worth. They didn't care that he was trying to save for his daughter's college. They just saw a larger pipe of cash flowing into his checking account, and they wanted to attach their own little siphon to it.
This is exactly why you have to start protecting your financial data like it is a closely guarded trade secret. Your bank is treating it like one, and they are using it to build a predictive profile of your spending behavior. But let's flip the script for a second, because this is where it gets really interesting and honestly a little bit terrifying. What happens when your income goes down? Let's say the economy takes a hit. Your company does a round of layoffs and suddenly you're on unemployment, or maybe you had to take a massive pay cut to switch to a new industry. You're stressed, you're calculating every single penny, and you log into your banking app to see if your grocery budget can stretch another week. Up pops the box. Please update your annual income. Because you are a good, honest person, you delete that old $75,000 number, and with a sinking feeling in your stomach, you type in your new reality, $30,000. Here is what most people don't realize happens next. The bank's algorithm, which was your best friend when you were making the big bucks, instantly flags your account for a severe risk review. They don't send you a comforting email offering financial counseling. Instead, they look at your current open credit limits and they panic. Let's say you have a credit card with them. It has a $10,000 limit, and because things have been tight lately, you're currently carrying a $3,000 balance. In the past, that $3,000 balance against a $10,000 limit meant your credit utilization was at 30%. That's right on the edge of what's considered good by the credit bureaus. Your score is probably sitting nicely around a 720.
But the moment you update your income to $30,000, the bank's software decides you can no longer be trusted with a $10,000 limit. It's too much exposure for them. So without warning, they slash your credit limit from $10,000 down to $3,500. Let's do the math on what just happened. You still only owe $3,000. You haven't spent a single dime more, but overnight, your utilization ratio skyrockets from a healthy 30% to a catastrophic 85%. The credit bureaus get notified immediately. Your FICO score plummets by 60, maybe even 80 points. Because your score just tanked, your other credit card companies, who constantly run soft checks on your credit profile, see the drop. They get spooked and they start slashing your limits too. It's a vicious mathematical death spiral, all because you innocently thought you were required to tell your bank you took a pay cut. It genuinely makes me so mad when I see this happen to people who are already down on their luck. The bank will gladly hand you the rope to hang yourself when you're rich, but they will violently yank the safety net out from under you the second you stumble. Now, you might be thinking, wait, Scarlett, isn't it illegal to lie to the bank? Don't I have to tell them my income when they ask? Please listen to me carefully here. There is a massive, critical legal difference between applying for a new loan and maintaining an existing account. If you are filling out an application for a mortgage, a car loan, or a brand new credit card, yes, you must be 100% truthful. Lying on a credit application is bank fraud. Don't do that. But when a pop-up interrupts your screen on an account you already have, you are under absolutely zero legal obligation to update that information. None. You are not under oath. It is a marketing and risk assessment dragnet. Look for the little gray X in the top corner. Sometimes they make it super transparent. Sometimes they use dark patterns and hide a tiny Remind Me Later link at the very bottom in 8-point font. Find it, click it, bypass the screen. You do not owe them an update on your livelihood. So what are the clear, actionable steps you need to take right now to stop playing their game? First, implement a strict need-to-know policy with your bank. The only time your bank needs to know your income has increased is if you have a strategic mathematical reason for needing more of their money. If you are intentionally trying to increase your credit limit to finance a specific planned purchase that you have a payoff strategy for, then sure, go ahead and update it. You are using them as a tool. But if you don't actively need something from them, keep your cards close to your chest. Second, if your bank has already automatically bumped your credit limit and you know deep down that having a $15,000 limit is going to tempt you into making bad decisions, you can literally just call the number on the back of your card and ask them to lower it. Say, "Hi, I noticed my limit was increased to $15,000. Please reduce it back to $5,000. I promise you, the customer service rep will be confused because nobody ever does this. But you are the CEO of your money. You dictate the terms. Third, go into your banking app settings and look for the privacy and marketing preferences. Opt out of pre-screened offers. You can also go to optoutprescreen.com, which is the official site run by the major credit bureaus, and stop them from legally selling your data to lenders who want to spam your mailbox with loan offers. By removing the temptation entirely, you take back your psychological power. According to the Consumer Financial Protection Bureau, credit card companies made over $130 billion, with a B, in interest and fees in a single year. $130 billion. That money didn't magically appear out of thin air. It came from people just like you and me who got comfortable, let their guard down, and allowed lifestyle creep to take over because the bank made it feel so incredibly easy to spend money we hadn't actually earned yet. You work way too hard for your paycheck to let a banking algorithm dictate how you spend it. Keep your success to yourself, keep your financial struggles private, and let the bank mind its own business. If this video shifted your perspective today, or if you've ever fallen for the update your income trap, let me know in the comments below. Don't forget to hit that subscribe button, like the video, and share this with a friend who just got a promotion so they don't go out and buy a $55,000 truck they don't need. I'm Scarlett, thank you so much for watching, and I'll see you in the next one.